know he is not a myth. It's been 13 years since the market crashed 60%. Some people still haven't recovered, but he has because he never failed.
Get ready, because this is going to be a wild ride. I've built something I think is pretty incredible here, and by the end of the video, you're probably going to agree. To create the Immortal Portfolio, I started with Chris Cole's Dragon Portfolio. It's the subject of a fascinating paper that I think came out around 2020, I want to say. I'll include a link to it in the video description for those interested. But he started with the S&P 500 weighted at 24%, gold weighted at 19%, intermediate treasury bonds weighted at 18%, managed futures at 18%, and what he called long volatility, which is actually kind of a options overlay on stocks, similar to what the Chaos ETF does at 21%. Back then, there weren't too many funds available to retail investors to pull off things like Chaos does now, but the first thing I noticed about the way that he weights things here is it's very overfitted to a 100-year back test. So in phase one, I adjusted the weights to more pretty round numbers. So 30 for equities, 20 for gold, 15 for intermediate treasuries, 15 for managed futures, and 20 for long volatility. But there are some redundancies in this, and in my opinion, undesirable redundancies. So I collapsed Chaos and the intermediate treasuries into a single holding of EDV because I do think that zero coupon strips, extended duration US treasuries are probably a better route for most investors to hedge fast market crashes than Chaos. I have another video comparing EDV and Chaos, so please be sure to check that out. But this simplifies things to just 4 positions. And then what I did next is use capital efficiency on gold because I like gold, but it has decades where it's basically dead weight and doesn't go anywhere. I think a lot of people are very enamored with the run that gold has had recently and have forgotten completely about what it did in the 90s or the huge gold crash during the 70s, even though gold was a very good performing asset during the 70s. So I prefer to actually overlay gold on stocks. And fortunately, there is a fund from Wisdom Tree that allows for that. So it's called GDE and it does 90% stocks and then does a 90% gold overlay on that using futures contracts that are backed up by about a 10% cash collateral. That approach is called return stacking, and I will have a video on that later that will explain in detail exactly what it is and how it works and whether it's worth it to borrow assets with the assets that you own. But this allows us to extend our equity allocation from 30% to about 48% now because of that GDE allocation. And this last fund right here with 4 line items is what I call the Immortal Portfolio because it's a little bit more optimistic than Chris Cole's Dragon Portfolio, and optimists tend to win in the end. Empirical data backs that up, and I'll also have a video on that. But let's go ahead and look at the back test here. So as you can see, at each phase, I'm improving that original Dragon portfolio overall in terms of its rate of return and risk-adjusted metrics. I mean, the original Dragon portfolio, some people might be okay with about 8% compounded annual growth, but I want to try and get it up a little bit above that for myself, since this is a portfolio that I want to use as a base. And so 11.82% is a little bit better here. Now, I didn't stop here though, because one thing you'll notice about the Immortal Portfolio displayed on the screen is that it is only in US large caps, and that's just not my style. So I used this as a base and then switched it up a little bit. What is my style? Well, flexibility. I like accommodating many different styles, and I tend to go toward a kind of an agnostic allocation when it comes to domestic versus international stocks, so 50-50. But before we get to exactly what I'm doing in my portfolio, let's look at some of the things anybody could do with this structure. The Immortal Portfolio design is a structure for plug and play. It's not a single immutable portfolio. So you can put large momentum in that equity slot. You could put small cap value in that 30% equity slot. You could put global equity in that 30% slot. And right here to kind of see how the Immortal Portfolio structure performs over time, I went ahead and sampled DBMF using a Monte Carlo simulation and extended it out to about 50 years. So the backtest that you're going to see is a conservative estimate on what the Immortal Portfolio structure would return, simply because that sample of DBMF going back that far, it's not interacting as it should with other factors and stocks and stuff. It moves in tandem with it. That's the whole point of managed futures. It picks up trends. So resampling with a Monte Carlo simulation and taking the median result of those simulations is not really going to capture that trending behavior that DBMF shows alongside the other positions in a portfolio. So keep in mind that this is a conservative back test on these. So the first thing to note is the 60-month compound annual growth for all of the Immortal Portfolio structures that I'm showing here. It's really nice. It reduces your sequence of return risk quite well and allows you to be more confident about entering into investment at any given point, because it's not going to go all over the place like, say, the total US stock market. You can see that there's times where your 60-month compound annual growth is just pitiful. Sometimes it's negative. Same thing with the total world market. The genius of the Immortal Portfolio construction is that it compresses that compound annual growth rate into a more tame pattern. So, yes, it keeps pace for the most part with a total equities portfolio during bull runs, but it only has to run so fast in order to overcome a pure equity portfolio when it stumbles. And you can see this on the summary over here. All three Immortal Portfolio options significantly outperformed the total US stock market and the total world market over the past 54 years on both absolute and risk adjusted returns. You've got the Immortal Small Value Portfolio with a Sharpe ratio of 7.75. Large momentum, which is the back test of the SPMO index. And yes, that is available for 54 years now, which is pretty neat to see how SPMO performed or would have performed in the past. And Immortal Global at 0.65 on the Sharpe ratio. The US market is pretty poor at 0.45, and total world market is pretty poor at 0.39. And you can see from this chart which has been adjusted to logarithmic scale, that Immortal Large Momentum, Immortal Small Value, and Immortal Global are sitting on the top for most of the history that we're testing here. You can see the big crash back in the 70s. The Immortal portfolios just skip right over that dip. They do exhibit some similar behavior to the total equity portfolios, but always staying above them until you get to the dot-com bomb, or rather the bubble first. You can see that the total US stock market finally overtakes the Immortal Global portfolio, but just for a bit before it crashes down. And then all three Immortal portfolios remain in the lead for the next 26 years. And if we take it off the logarithmic scale, it really helps visualize the disparity in wealth that's generated here with these Immortal portfolio structures. So, pretty cool. So, which of these three have I chosen? None of the above. Let me show you the two modifications I'm currently running on this. Both versions that I'm running use Avantis Global Value as their core equity fund for that 30% of the structure. But the first one that I'm running, I'm doing at about 25% leverage, so 1.25x in an M1 brokerage account. And it's done fairly well so far. And the second version that I'm running in my retirement accounts and plan to stick with for the most part for the rest of my earthly existence is, well, God help me to stay consistent with that, is what I'm terming the Immortal Retirement Fund. And it uses the same global value fund for that 30% equity allocation, and splits the extended duration treasuries into 10% treasuries. And then instead of treasuries, I go for cat bonds. If you watch this channel, you know that I love cat bonds. Cat bonds are great. They are totally non correlated to the stock market. Reinsurance is awesome. Larry Swedroe likes reinsurance. It's a vastly underrated asset category. So, with these two, we can look at the back test here and see how they would have done over the past 24 years with 50% relative rebalancing. No scheduled rebalancing, though. So, only when allocations drift at least 50% from their targets do I rebalance. And $800 monthly contributions. So, the Immortal Brokerage account gets up here at $1.8 million. Not bad. Compound annual growth rate of about 14.62%, money weighted return of about 13.80%. But here's the cool thing: the max drawdown was only 32% on that. Its Sharpe ratio was 98.98, that is. So compare that to the total US stock market at 0.52, the total world market at 0.47. That's not half bad. It's beating every other portfolio on this list, including my retirement account, which is fine. A retirement account is supposed to be a little bit more conservative. As you can see, it has a slightly less max drawdown. Its average drawdown is slightly less. Its longest drawdown is only 1.6 years. It's a little less volatile. That's absolutely fine. It's still beating the world market, and it's still beating Warren Buffett's Berkshire Hathaway. Maybe not as much as the Immortal Brokerage one is beating it, but it's still doing well there. And the great thing about this is that sequence of return risk is minimized. So when I take the other options off, you can see that we still have that nice compressed positive 60-month compound annual growth rate going on here for this version of the Immortal portfolio structure. So it's pretty cool, and you can see how it behaves. And when we switch to the logarithmic scale, you can see how the Immortal portfolio structures are just skipping right over the great financial crisis, and it takes a very, very, very long time for the total US market, total world market, and Warren Buffett to catch up and start becoming competitive again with either of the Immortal Portfolio structures. And it's probably likely that when the next crash happens, and it's a when, not a question of if, the Immortal Portfolios are going to again be uncontested leaders among these. So, in a future video, I'm going to dive into how I simulated the Avantis Global Value Portfolio. And I'll talk a little bit more about how I do custom indices with testful.io. Unfortunately, you can't tinker with all of the back tests that I show on my channel because that requires a paid subscription to the site, and it also requires a little bit of statistical know-how on how to interpret the tests like factor analysis that you can do on these portfolios. But I do want to do a deep dive into my take on the Immortal Portfolio structure in a future video. For the time being, though, I wanted to introduce you, my gracious viewers, to the concept of the Immortal Portfolio structure and why I have decided to commit to it for my retirement and investment funds going forward, seeing that I am now almost 40 years old. And that means I have to think about preventing catastrophic losses as much as getting gains, because I don't have the luxury of waiting forever to recover from a potential 60% drawdown like I might have in my 20s, which forces me to look at more conservative approaches, which nevertheless remain competitive with an all equity portfolio. And I really, really like bringing together non correlated sources of return. As you can see in the Immortal Portfolio structure, it's bringing in equities, it's bringing in gold, and it's doing gold in a smart way, recognizing that it can be dead weight for extended periods and essentially renting it on top of stocks. It's bringing in managed futures and trend. It's bringing in fixed income in the form of extended duration treasuries and using a 10% allocation to EDV to get the same sort of duration you'd have with a 30% allocation to intermediate treasuries. And then it's bringing in cat bonds, also called reinsurance, which is another totally non correlated asset class. And working together with that 50% relative rebalance band to harvest volatility between the sleeves as a sort of invisible additional asset. I have a video about Shannon's demon. Go watch it. It's incredible. It's a phenomenon in information theory that can be used with rebalancing stock portfolios. But anyway, bringing all of those non correlated revenue streams together, those return streams rather, um, allows me to be competitive or even beat all equities portfolios with a fraction of the risk by actually having less stocks and more stuff from other markets. If you've enjoyed this video, don't forget to like and subscribe, and hey, leave me a comment. Y'all have posted some pretty insightful questions, and one of you even came up with a portfolio that I am going to showcase in a future video. And don't worry, I will give you full credit there. I also cannot wait to dive into how I did the backtest simulation for Avantis Global Value Portfolio and go behind the scenes to show how I do simulations for extending out, say, DBMF to 54 years and creating custom tickers, and give you an overview of how to make sense of a factor analysis when it comes to a portfolio and how to run a Monte Carlo simulation. I also want to do a deep dive into each of the two versions of the Immortal Portfolio that I'm personally using. and what I think could improve them should the funds become available in the future. And by that I mean a global equities stacked on top of gold fund. Hopefully, Return Stack, you're watching and you're going to release that. But anyway, I will catch you next time. It's always a joy to make these videos for you.